Thanks, Bernard, and good afternoon, everybody. And Bernard, thanks very much for having me back. So before we get into the presentation today, I'll just take a few minutes just to explain a little bit around what Valterra Platinum is. And so the cautionary announcement that you see on the screen, just to draw your attention to it, and importantly, I encourage you to read it at your convenience.
No, but I've interpreted before. It says, I will probably lie. Shall I interpret the rest? No, carry on.
So, as Bernard referenced, at this year's PGM Day in Johannesburg, he asked me in his very own unique way, and I won't repeat the words that he used, well, what is Valterra Platinum? And so I'm going to use this opportunity just to explain what it is and to extrapolate that a little bit more. But effectively, for those of you who don't know, Valterra Platinum is the company which was formerly Anglo American Platinum, which came out of the Anglo American Group stable at the beginning of June, and we're now successfully trading on both the Johannesburg and the London Stock Exchange. But more importantly, let me take a moment to reaffirm who we are and what our strategic priorities are. So we are a leading PGM producer, strategically focused on extracting the value from our existing Tier 1 assets in Southern Africa. Our operations are in the PGM-rich Bushveld Igneous Complex in South Africa, as well as the Great Dyke region in Zimbabwe. We have 3 marketing offices, one located here in London, as well as in Shanghai, as well as in Singapore. And we proudly employ 29,000 people, and our market capitalization following the demerger from Anglo American is approximately $11 billion. And our annual revenues exceed about $6 billion, and reinforces our position as a very significant and meaningful PGM producer in the sector. As I've been saying over the last number of weeks and months, we have a world-class portfolio of assets which are integrated from both mining, refining, all the way to end markets. And through this integrated value chain, we're able to produce high-quality metals for our customers and create sustainable value for all of our stakeholders. And among our peers, we are the undisputed leader in the PGMs industry, leading in attributable mineral resources, inclusive of mineral reserves. And we also have an exceptionally strong track record of generating earnings, in average far exceeding that of our peers. And as a company, we're guided by our purpose, which is really to unearth value to better our world. And we have 5 key strategic priorities that will guide us in terms of how we look to the future and how we look to operate. We do have a rich legacy created over many years, which has meant operating to the very highest standards of integrity, trust, accountability, as well as sustainable impact. And looking ahead, our 5 strategic pillars are focused around advancing safety and health, achieving zero harm. That remains our top priority, because we believe that a focus on safety and the advancement of health and the well-being of every single one of my colleagues will result in zero harm and that becoming a reality. We have an experienced team with a strong track record of delivery to lead our simplified and strengthened organization. And the opportunities for us as a standalone entity is to do that in a much more simplistic and agile manner. We're also incredibly focused around operational excellence. And our operational excellence is really centered around our program to ensure that all of our assets operate sustainably in the lower half of the industry cost curve. And because of the quality of the portfolio of assets that we have, we're looking to invest in what we believe are the most valuable ore bodies in the PGM industry. And through our disciplined capital allocation approach, looking to maximize returns while recognizing the unique contribution of every asset within the portfolio. And then driving demand to ensure our long-term success. In terms of driving demand for our metals, we play our part to support and develop emerging demand opportunities. And finally, sustainability is integrated into everything that we do, both protecting and looking to create value for all of our stakeholders. So now just move on to why we believe that we have such a strong conviction in the outlook for PGMs and what some of those market dynamics are that gives us the confidence in terms of our outlook. So as many of you know, 80% of the world's PGMs are located in Southern Africa. But PGMs will remain and continue to be globally strategic. PGMs, under various definitions, have been classified as critical minerals in many countries and trading blocks. And the societal benefits of mining and processing PGMs are far-reaching. So, for example, they represent around 5% of GDP. They represent about 10% of export earnings of South Africa, while supporting tens of thousands of jobs and generating substantial fiscal revenues. And at Valterra Platinum, we mine and refine a multitude of products. But of course, PGMs are the cornerstone of what we do. They represent between 85% and 95% of revenue over the last 5 years. And because gold is the reason to exist at the moment, we produced around 90,000 ounces of gold and represents around about 4% of last year's revenue. In terms of the demand for PGMs and why we believe in such a strong position going forward, demand for PGMs in 2024 amounted to around 20 million ounces. While the volumes seem small, their prices, even at last year's prices, resulted in a substantial market value of about $24 billion. But what makes PGMs so valuable are their unique properties, which are indispensable in a wide range of modern applications. For instance, they serve as excellent catalysts, playing critical roles in cleaning the auto exhaust and manufacturing chemicals. Their remarkable metallurgical properties, such as their high strength and melting points, make them suitable for crucibles, for LCD and fiberglass production. And their stable chemistry makes them useful in a wide range of other applications, from pharmaceuticals to LED TVs, to LED TV screens. And PGMs are also attractive and resistant to wear and tarnish, making them ideal for fine jewelry as well as investments. So breaking down the market demand for PGMs, investments make up around about 3% of total demand. About 5% of PGM demand came from jewelry, although about a sixth of that is represented in platinum demand. Just over a quarter goes into various industrial uses, with the sector making up a large proportion of the platinum demand and the bulk of ruthenium and iridium. However, by far, the largest use at present, accounting for 66% of its value and more than 80% of demand for palladium and rhodium, is the automotive sector, where they're used in emission controls, catalytic converters, oxygen sensors, as well as spark plugs. So given what's going on in the automotive sector, let me unpack that a little bit more. Automotive demand is a function of the number of vehicles which are produced and the share of those vehicles that are catalyzed, PGM loadings per vehicle across both light and heavy-duty vehicles. So if we look to the outlook for automotive demand, so starting with how many new cars will be bought and sold in a year. Historically, growth demand in GDP has gone together with rising car sales. But as you can see in the chart, that includes a rather conservative line, which indicates what would happen if the trend continued to hold. However, consensus implies that an inflection point has been reached, and the age-old relationship of that correlation no longer holds. And forecasts attribute that change to our changing relationship with cars, being that due to urbanization, public transport, and affordability, that disconnect will materialize. Now, any sudden divergence from long-term trends do happen, but they happen rarely. And if that correlation did reinstate itself in terms of forecast, you could see an additional 1 million to 1.5 million ounces of additional demand by this end of this decade versus what's in current forecasts. So that brings us onto the next factor in the equation, the share of catalyzed vehicles. market demand overwhelmingly still favors internal combustion vehicles, with BEVs only having a small share of total car sales. In established markets such as the US, Europe, and Japan, BEVs had just 10% of market share last year, barely higher than what they experienced in 2023. In emerging markets outside of China, that share is just 3%. China is clearly unique and an exception, where BEV penetration reached about 25% of new sales, and it continues to grow. That led some to believe that what happens in China will take place in the rest of the world. But China, as I said, is unique. It doesn't have a long history of internal combustion engine vehicle ownership, and it's rapidly invested in EV infrastructure. It also benefits from the dense urbanization and a reliable high-speed rail system. Still, pure electric vehicles aren't practical for everyone in China, and with range anxiety remaining a concern, as a consequence, you've seen a rise in plug-in hybrids and other range extender vehicles, which then have gone on, which still require PGMs, and therefore speak to our longer-term outlook in terms of how just the energy transition and the adoption of BEVs is likely to unfold. So due to the challenges of the slow expansion of charging networks, high purchase prices, insurance costs, and unclear resale values, and even political barriers like tariffs and subsidy roadblocks, we don't believe that the BEV growth will be as significant as previously forecast. So while we recognize that BEVs are gaining ground, ICE and catalyzed vehicles are likely to remain dominant for longer than expected. And this is portrayed in the next slide, where you've seen the forecast for battery electric vehicles shifting down since 2023, and they continue to be revised downwards. And just that movement from the forecast at the end of 2023 to the end of 2024, that change in penetration of battery electric vehicles results in an additional 1 million ounces of PGM demand at the end of this decade. So moving on to the last factor of that equation, how much PGMs in those cars are still have catalytic converters, more commonly known as loadings. So tighter emission standards and testing generally lead to higher PGM loadings per vehicle. The upward pressure on demand is sometimes balanced by automakers engaging in thrifting, that is, reducing the amount of PGMs used through more efficient catalyzed designs or alternative technologies. And in Europe and the US, upcoming regulatory changes, such as the potential shifts in the US emissions policy, as well as the introduction of Euro 7 standard, is expected to sustain or even increase the upward pressure on PGM loadings. And as emission limits tighten and enforcement becomes more rigorous, automotive makers are likely to require higher catalysts in order to comply with their requirements. And meanwhile, what we've been tracking several proposed policy changes in China, where loadings in recent years have fallen notably lower than in other countries with similar emissions legislation. These have been aimed at strengthening compliance with existing rules, especially for hybrids and trucks. And in May, the first of these were finalized, where there is a growing agreement that there is likely to be more supportive for PGM demand in that sector in China. So PGMs aren't just used in vehicles. About 40% of demand comes from other industries. These include the catalyst for making chemicals, hard drives used in the internet and for AI, fiberglass production for wind turbines, and copper foil used in lithium batteries. So existing industrial demand looks strong, thanks to economic growth, rising middle classes, and investment in infrastructure, as well as advancing technology. And even more exciting is their potential for new uses, especially as we think through the energy transition in the likes of the hydrogen economy, green aviation, e-fuels, and carbon-neutral feedstocks, to name just a few. And as the world pushes for cleaner, more efficient technologies, PGMs will remain a key to enabling the low-carbon, low-cost chemical reactions. In terms of demand for jewelry, platinum jewelry in China has declined over the past decade, mainly due to lower luxury spending and a preference for gold as an investment. Since China was a major market, this affected global platinum sales, despite steady growth in regions in the US and in India, for example. However, this trend seems to be changing. And in 2024, China's reduced market share meant that the impact was less significant. Additionally, gold prices, now 3 times higher than platinum, create an opportunity for platinum to regain some of that market share from white gold. White gold was originally developed as a cheaper alternative to platinum. And so if platinum wins back just 10% of the white gold market, demand could rise by a further 1.5 million ounces for platinum per year. This is also potential for platinum to compete with yellow gold due to its value. Platinum jewelry sales in China have strengthened, and several other major brands are launching new collections, which we've been participative of. So turning to supply. As I mentioned before, Southern Africa holds around 80% of the world's PGM reserves, making it a dominant supplier. This presents both opportunities and challenges while reinforcing South Africa's strategic role. It also means that supply is shaped by regional factors like regulation, infrastructure, and geopolitical risks. Valterra Platinum, with 30% of these resources, is well positioned to deliver the reliable supply, maximizing the opportunities that we see, as well as managing the risks. Our priorities, as I've said, are on operational excellence, sustainability, and our cost competitiveness to ensure our long-term value creation. And industry forecasts have continued to overestimate PGM supply growth, failing to account for the financial sustainability and the infrastructure challenges. So many producers are cutting costs, holding back on spending, and not replacing old mines. This will lead to lower long-term supply. And while prices may rise eventually to attract new investment, supply cannot respond quickly due to the long project timelines. The industry is faced with real challenges. Little investment in new mines over the past decade, aging operations, and that shift from growth strategies to maintenance strategies. But at Valterra Platinum, we've taken a very different approach. We've balanced our approach in terms of both in reinvesting in our operations and returning cash to shareholders. Still, the overall result is a shrinking supply base, with only 2 projects announced in 2012 still running today. Supply could drop by another 15 to 20% by the end of this decade, while demand remains strong, keeping the markets firmly in a deficit for many years to come. Recycled volume continues to underperform. Recycled volume is an important supplier into the market, but it represents about 20% of supply, mainly from catalytic converters, far below copper's 32% recycled supply last year. We expect recycling supply to increase, but not at the rate as currently forecast. And forecasts have overestimated PGM supply, ignoring challenges like vehicle scrapping, economics, and stricter sustainability rules, as well as refining capacity. So while the demand drivers remain uncertain, there is reason to be optimistic as vehicle sales trend back to historical levels. The BEV adoption is slower than expected, while primary and secondary supply stay constrained due to the uncertainty and low investment. In the short term, cost competitiveness will always be key as producers manage low prices while preparing for long-term growth and value creation. So let me just briefly touch on our approach to market development. In terms of driving demand for our metals, our investment into growing the existing sources of demand and developing new ones is imperative to us, and it aligns with our requirement to invest given the scale of the endowment that we have. But we'll be disciplined in terms of how we allocate capital into market development. We'll invest in future use cases because the opportunity for demand growth is both achievable as well as compelling. And we believe we're well placed to shape the future demand dynamics of our metals and create value for our customers at the same time. The 4 main levers that we'll be focused on going forward is advocating for a supportive regulatory environment shaping the demand dynamics, nurturing new PGM applications and a new PGM business through funding research development and taking positions in startup businesses, and venturing, investing where we see potential for PGM demand in emerging sectors and technologies. and we're actively looking to collaborate with our partners across the value chains, both horizontally and vertically, to drive the demand for our products. And as we've outlined here, the various segments where we see future demand growth in PGMs are significant, with mobility being key in terms of the hydrogen economy, potentially adding an additional 6 million ounces of PGM demand, while the industrial sector could add an additional 2.3 million ounces of demand coming through PGMs utilization in AI and computing, as well as jewellery. And I've touched on the opportunities to substitute white gold for platinum going forward. So now let me close before Bernard says I've purposely used up all the time to avoid the questions and answers. But simply put, the world needs our metals now and to enable a cleaner, greener, and healthier tomorrow. The PGM market fundamentals are robust. In terms of existing demand, this remains stronger than previously forecast, and we see new demand segments as we look to the energy transition, dealing with climate change. And meanwhile, primary supply is shrinking, secondary supply continues to disappoint, leading to ongoing deficits that support a positive outlook for our metals. So finally, we're confident around our leading position of the portfolio of PGM assets that we have, with the resource endowment to enable and support our growth ambitions. Our world-class integrated value chain positions us to be able to mine, process, and market the metals that we produce. We have the capability within our teams to continue to deliver a resilient performance. Our operational excellence and delivery remain at the forefront of what we do, and I remain confident in our ability to continue to deliver the strong margins well above our peers. And we'll continue to maintain a disciplined and value-aligned capital allocation, maintaining a strong balance sheet with a net debt to EBITDA ratio of less than 1 through the cycle. And we'll continue to maintain our dividend policy, continuing to return value to our shareholders through the cycle. And underpinning all of this is our commitment to zero harm and integrating sustainability into everything we do. Thank you, Bernard.
Thank you, Fred. You know, sometimes I wish I came up with these questions, but I didn't. So the first question, you know where that's going. How does it feel like to not have to report to Duncan? Thank you for that question, whoever sent that. No, but seriously, you and I go back to, I said, that's a nice job you got. You found London, you get instructions. The next year I said, shit, dude, what happened? It's not what is happening here. So talk us through you joined, was asked to lead the company. Then this plan to demerge, I think, happened subsequently. You stayed on. If you had a good union rep, you probably could have negotiated a package, because that's not what you signed up for. And here we are today. There's no Duncan in your life, or whoever. Talk us through the journey for you personally, and then we can get to the team and the company.
Yeah, thanks, Bernard. Yeah, I mean, look, having the opportunity to lead what was then Anglo Platinum was a great opportunity for me, personally, just given my career that I'd had at Anglo. But I recognized that we needed to do some tough things in 2024. Let's not forget, not only did we progress the demerger, we also went through a massive restructuring where we've needed to reduce our cost base, where we reduced our workforce by almost 20%, but really setting ourselves up for a sustainable future. And then coupled with that was really then the demerger. And I think what was really been quite striking over the last sort of month that we've been really celebrating, launching Valterra Platinum, is just the amount of work that's been done to set ourselves up for success. But more importantly for me, is just what the opportunities present ourselves. And what I have certainly seen in the business in the last month, as I've been going around all of our assets in both South Africa and Zimbabwe, is just the excitement and the opportunity that every single one of my colleagues see for the future, and just being able to really create that value that we fundamentally see in our business for all of our stakeholders. And that's what's really exciting about it going forward, and that's the reason why I did the demerger, and I didn't take the package. I mean, it's been a brilliant opportunity, and really excited about what the future holds for us.
So I mean, I think anybody who lives near your team of people are aware that this was a busy year. I mean, a demerger came with a lot of work. That part went successfully. Do you worry that any other balls could have been dropped in your operations or so on? Because, I mean, clearly, a lot of focus was on demerging.
Yeah, but I think there was two things. I think, look, when we did the demerger, we clearly separated the teams, and I had quite a significant focus on what I term sort of business as usual, for us to continue to deliver what we needed to deliver. And we set out the objectives last year around the 12 billion rand cost out program. Well, it was we delivered on that, and then we set up the team to work through the separation and the demerger. And so I think probably the biggest thing that was what is the biggest disappointment are the 3 fatalities that we had at Amandelbult last year. And there's been a lot of introspection around that in terms of, how did that happen? Why did it occur? Is it related to the demerger? And we recognize that change is a massive thing in anybody's life, and we could have done better. And so that's where our focus is and our commitment back to achieving that zero harm and getting our safety record where it needs to be.
So if we change gears a bit, this Anglo Platinum has always been this big monster. I mean, we sadly recognize Barry Davidson's passing a day or two ago. Barry stood up at international conferences and talking with the arrogance that could only come from Anglo Platinum. Like, we make the market, we are the market, we decide what rate we mine at, etc. That narrative's gone much softer in the last 10 years or so, perhaps personality-wise so. But will you step up and be the big gorilla? Are you now the big gorilla? Are you now loose to be the face of platinum, the voice of platinum, the key decision maker in the industry?
I think, Bernard, the one key thing for us as a business is that we're very focused around that value over volume strategy. And so, the volume is not the key driver in terms of how we're going to look as a business. But we recognize that we are a meaningful producer in South Africa. I mean, we produce between 3 and 3.5 million ounces. We have 30% of the global PGM resource base. The opportunity for us is to extract the value that we have from those tier 1 assets. So you saw one of the graphs that I showed, just the scale of the resources that we have within our portfolio. And the opportunity for us is very much focused around how you extract that value. And that's particularly focused around Mogalakwena and how we would look to grow that in a very disciplined way, so that we look to create that value as opposed to just chasing the volume.
So Michelle of McKinsey sort of intimated that, like, with only 40% of world oil, OPEC is doing fantastic manipulation. He then goes on to say, and in platinum, there's high concentration even in a single producer. So what should the platinum industry do, the PGMs industry, do more to collaborate? And I'm not asking collusion. There are too many lawyers in the room, so you all relax. This is not a collusion question. But is there more collaboration? I mean, could we just get Frenneman to contribute to market development? I mean, just talk a little bit about the platinum space, your role as the leading company in collaboration.
So I think there's always an opportunity to collaborate more. And I outlined where we see the opportunities around future demand segments, recognizing that, the changes in mobility are a factor that could impact PGM demand. And so as collaborating in a way where we can try and drive sort of policy change that's required in order to support, hydrogen application, the role of PGMs in hydrogen is absolutely a key area. Looking at new ways in new innovation centers. And so we can do that, I think, differently to how we've done it in the past. And we're all now big players in this industry. We all have a role to play as opposed to just assuming that Anglo Platinum in the past or Valterra Platinum in the future will step up. And that for us, the focus is very much back to what I said, we'll be disciplined in how we look at allocating capital in market development. It needs to generate a return. And I do think as an industry, if we adopt that position, then we can create these demand segments for the future.
So why is it that the platinum industry chase itself down to the bottom? So you can say, but I've got the best assets, so I'm not affected. But what in the model means that we oversupply platinum? There's a time when it looks like people don't want to buy the stuff at the price at which we mine it, but we continue to mine it. I mean, Mike was sharing that in gold, that they've got a reserve price that features all the way through to their mine plans. In platinum, what is different? Why do we chase each other to the bottom?
That's a good question. I don't necessarily think that we need to chase one another to the bottom. I think we just need to recognize that if you're producing unprofitable ounces, you shouldn't be producing that.
Is the man who is now going to tell me he produced no unprofitable ounces, and therefore can you just cut yours and you cut yours?
Well, we worked really hard to get our assets to where they needed to be. And so, I've been very, very clear that if we produce unprofitable ounces, that's not sustainable. We won't put the rest of the business at risk. And that's why we took the decisions that we did last year. And as a consequence of that, all the assets are in the low half of the cost curve and sustainably generating cash. And that's really our thesis going forward as Valterra Platinum.
I am not going to ask you about my famous truck. I'm sure it's not even on site anymore.
I actually have a truck at Mogalakwena. It's rebranded in Valterra Platinum colors. So I'm going to invite you, Bernard, to come and have a photo.
Can I drive it, please?
But it's not a hydrogen truck. It's a diesel powered truck.
No, this truck goes way back. This truck goes, the first movement of the truck is the issue. I really want to perhaps wrap up, because we stand between these people and their lunchtime. You guys came back from the Platinum Week, and you all drank some Kool-Aid. There was a narrative going to the Platinum Week, and I mean, I put it to you at the Platinum Day that, is it because you have to launch your company and, unbundle that you are so bullish, but your colleagues are as bullish suddenly. So what the hell is different? I mean, for those of us a bit further away, the EV trend is what it was. The jewelry can be better, but it isn't yet. And yet the narrative and the pricing of platinum especially is different. So what happened there? Can you have more meetings like that? Where was the meeting? Talk to us about.
Yeah, it was here in London, so Platinum Week, which is an annual event. And Bernard, what typically happens in Platinum Week, the week thereafter, the platinum prices rise, and then the second week they actually fall. What's clearly different this year is the platinum prices continue to rise, and they're now trading at around about $1,300 an ounce. I think the important thing is what we've been saying for quite some time, is the market is in deficit. Demand is much more robust than people were sort of analyzing. And as a consequence of lower supply and that rising demand, you're going to see some price reaction. And that has started to come through. We've started to see increased demand coming through from China particularly. We're starting to see the OEMs, which we've said for quite some time, that they've reduced their inventory levels to sort of more normalized levels. And with the fact that EVs are not necessarily taking off for a variety of reasons, some of them I've articulated, you're starting to see that translate into higher platinum, higher palladium, and higher rhodium prices. And so I think that's sort of just starting to play itself out in terms of what we've been saying for quite some time.
And somewhere in another 78 days, I'm guessing Anglo will have a chance to sell their last 19%, and then Valterra will be a fantastic story, perhaps.
I think Valterra is already a fantastic story, Bernard. But
I'm not giving share advice. I'm just interpreting. Talking to my wife, she wants me to buy more implants and not Valterra. So I'm just testing.
All right. Well, I'll have a word with her and and convince her otherwise. But no, I think yes, Anglo American have a 90-day lockup period in terms of following the demerger, and after which they're able to
but it's
sell
worked very well so far. I mean, it served the purpose of the lockup.
No, absolutely. I think it's really daylighted what the strategy was from Anglo American, just both looking at the value of the platinum business and then obviously the rest of the assets within Anglo American. And so, yeah, we're very happy to be Valterra Platinum and looking forward to the future and the opportunities that lie ahead of us.
I've got a friend, who may be an ex-friend in South Africa, who I refer to as the ugly face of coal mining. I put to you the smooth face of platinum mining. Thank you, Craig.
Thanks, Bernard. Thanks very much. Thanks very much.